Hey, folks, welcome back to another episode of Advisor Insider. I'm your host, Jeff Benjamin, Wealth Management Editor here at ETF.com. And this week, we're going to get into a little bit of ESG talk, environmental, social, and governance investing. It kind of fell off the charts over the past couple of years. A few years ago, it was all anyone could talk about. And then I think through a confluence of poor performance and higher fees, and it became a little bit of a political football, or maybe a lot of bit of a political football. It's no longer the favored child out there. I know that Morningstar's data shows months and months of steady outflows from the category. But here to talk about that with me and break it all down, we have Jason Britton, founder of Reflection Asset Management. He's a bit of an ESG specialist in various ways, but we're going to get into that. But first of all, I want to welcome Jason. Jason, how are you doing today?
I'm well, Jeff. Thanks for having me.
Yeah, thanks for being here. Let's start with the state of the ESG space right now. I mean, did I overstate when I said ESG is kind of fallen out of favor? What's your take on it?
So my take on it is you have to bifurcate being out of favor at the asset management firms from a marketing perspective, or out of favor from how investors are looking at the world and what general trends look like on a go-forward basis. I'm in complete agreement that what was every marketing brochure for virtually every firm, which frankly I think we're going to get into, is part of the problem. That's going to go into, I think, a little bit of greenwashing we're going to talk about later. Everybody was talking about it because consumers were buying. And I think that everybody shouldn't have been talking about it because not everybody was talking about it authentically. But I agree with you completely that it has fallen off of the world stage. Larry Fink used to write about it in his annual letter. He doesn't even use those letters anymore. But it certainly has become, and I agree with the concept too, that it's become politicized. And I think that's part of the problem. It's the third rail now from a language perspective, and people don't want to touch it.
Yeah. Let's talk about Reflection Asset Management. What kind of an operation is this that you founded there?
Reflection Asset Management is a boutique asset management firm that specializes in thematic and values-based investing. And I say those words purposefully. It is different than traditional ESG. ESG historically has been one of two things, or a combination of two things: negative screening, which is don't buy alcohol, tobacco, firearms, gaming, and pornography, and ESG integration, which is how do you look at items around environment, social, and governance and incorporate that into your overall investment thesis. That's different than thematic and values-based, right? Those things are still from, especially the data on the ESG side, corporations' perspective, right? ESG risk specific. It's not from the values lens of the investor. We're exclusively focused on the investor and what they care about.
Do you have funds? Do you have ETFs? What do you have?
Yes, we are specifically responsible as the sub-advisor to a mutual fund referred to as the Sphere 500 Climate Fund, ticker symbol SPFFX. It is a passive, large cap core replication strategy offered at 7 basis points that essentially gives you the 500 largest companies, excluding fossil fuels and those that would be fossil fuel fired utilities. So it's the S&P 500 X energy, essentially. We also are the sub-advisor for an ETF called DEMS, DEMZ, and that's created by a company out of Madison, Wisconsin called Blue ETFs in partnership with the firm called Goods Unitas. And what they do is they look and track political spending and put together portfolios, or they ask us to put together portfolios of companies that give preponderantly to democratic causes. They also do have, it's not commercially available yet, but the ability to create what will be determined as REDS, REDZ, which is the exact opposite of DEMS. It's those companies that are contributing to Republican candidates and causes. The idea behind Reflection Asset Management is we don't tell people what their values ought to be. We help determine whether or not their values can be expressed in an investable strategy, and then we'll either build them a vehicle for it or create a separately managed account.
Okay, looks interesting, and I guess we'll wait for Reds to show up at some point, right? Is that filed? Do you know?
It is not. The registration statement has not been filed yet. No,
Okay.
we're holding the ticker at NASDAQ. And we're again looking for commercialization and partners on it. The point of Reflection Asset Management is to be the Intel inside, if you will. We
Mm-hmm.
bring the rigorous horsepower, research, portfolio construction. We do the same thing. We have a very large partnership coming up. We're going to be announcing around faith-based investing. We really are trying to actually bring investing back into the fray of personalization and customization.
All right. Looks like a lot of things you got going on there. I'm looking forward to hearing more about it. And please let us know here at ETF.com when you have something you can talk about. Okay.
Will do. Absolutely.
Let's get a little bit more granular on the ESG space. The kind of this is one of the things that I wanted to talk to you about, Jason, is the outlook for ESG. We know that it was quite a hot topic a few years ago. We already talked about kind of what's happened since then. Is there still hope for the ESG space, or does it have to evolve beyond what it has become?
So I'm not going to parse words with you, Jeff. I don't mean to sound as picky as it actually is not meant to be. The reality is the terminology ESG is dead, right? It's become so
Mm-hmm.
politically charged that folks are not going to be using it anymore. And I think that's actually okay. I actually think that is the natural evolution of the space because it was practiced poorly by many folks. And so when you say that there has been consistent outflows, yeah, there's been about $26 billion of outflows over the last 3 years. But funds that have opened with, I'm going to put air quotes in, you can't see it on the podcast because we're audio only today, 177 funds with some kind of thematic or values oriented word in it. That could be
Mm-hmm.
sustainability, which historically has not been treated the same as ESG. It could be faith. It could be some other kind of ESG adjacent topic. Issues were 177 over the last 3 years, according to Morningstar, with 93 closures. So you're still seeing fund manufacturers 2-to-1 on the opening side of those things that I would consider to be ESG like. What you're really watching is, in my opinion, the removal from the space of those practitioners that were not authentic. And the marketplace now is understanding, eyes wide open, and has more insight to what that means. The greenwashing part of our upcoming conversation, the wisdom trees and Invescos of the world who were making outlandish promises or hadn't the research or the talent or the experience to put these things together are not in the space anymore. And I actually think that's a good thing. I don't think that means that ESG failed. I think it means that those people who were not practicing it authentically and thoughtfully and weren't doing it for the investors' benefit have now been called to task. And you're going to see a
Mm-hmm.
natural whittling down of the space. And I think that's a very good thing. I think you're going to see authentic, data-driven, high-quality product emerge. The industry might be smaller as a whole, but I think it's going to be more true to what it actually was because people are going to be held more accountable on the marketing side.
Okay, so let me just connect the dots here. You're saying that ESG is dead, but the issuance of strategies that might qualify as somehow under the old terms of ESG are flourishing, right? People are filing.
That's correct. So that may sound a sort of axiomatic, right? Or a little bit oxymoronic, rather, where the reality is the term has been weaponized and people are going to pull away from it. You're going to start to
Mm-hmm.
see more focus on things like sustainability, climate change, air, water, biodiversity, sustainable agriculture, things that are ESG subcategories or would otherwise have been captured in that umbrella historically, but
Mm-hmm.
they're not going to be called ESG.
Okay, but even if the term has been weaponized, which I think is a great way to put it, and it's become very political, it still is a category that has really lagged in performance. How does renaming these things and repackaging them and maybe even breaking them up so you have specific themes within this broader category, how does that get fix the performance problem?
Well, so because it's the nature of my business and my expertise as a product engineer over the last 25 years affords me a different point of view in this, I would not argue that ESG strategies have done more more poorly than any of their other actively managed counterparts, depending upon what part of the business cycle you're looking at, right? ESG as a category could be everything from we're the S&P 500 X energy, which by the way, SPFFX as a strategy has done quite well. It has held up incredibly well over its 3-year track record. I would urge you to read the prospectus and to go out and look at those things online where all the information is. Not owning energy other than the February 2022 when Russia invaded Ukraine, and then the brief spike after the Israeli Hamas situation, for the most part, hasn't hurt you at all, not owning energy. Now, if you were a quote unquote ESG strategy and you were put together equal weight, you would have wildly underperformed, right, over the last 2 or 3 years. I would argue that has nothing to do with the fact that you were ESG and everything to do with the fact that the rally and the intense growth of quote unquote the market was driven by 7 stocks, and you may not have owned those 7 stocks. So the virtue of being ESG, or you may have owned them equal weight rather than market cap weight. It's not fair to paint ESG as a broad category with the brush that says it underperforms. It's much more likely that some of those strategies were put together poorly, or there were some other constraints. The nature of being called ESG isn't what made it underperform. There were lots of other small cap strategies until the last 12 months underperformed, but I wouldn't say that small cap investing is bad. There have been periods where owning the S&P Energy Index only, like through the DRLL, which I think is Vivek Ramaswamy's firm's ETF around energy. That's done very, very well in some periods and dramatically underperformed in others. I don't think you can say necessarily that drill as a strategy is bad. It's just a function of what period are you observing and what do the risk-adjusted returns look like, and is the portfolio manager any good at it? Is it the theme that's causing the problem, or is it the mechanic or the tool?
Okay, fair enough. But we can agree that it has basically falling out of favor as far as conversation goes, and I know you already talked about that with your
without
statement.
question.
But
without question, spot on.
Let's segue over to greenwashing. All right, it's not really much of a segue because the greenwashing and ESG kind of go hand in hand. I mean, there's nothing else that gets washed green except for ESG, and I'm not saying that it's all greenwashed. I'm certainly not saying that. I wrote a story a few weeks ago about Wisdom Tree Asset Management being fined $4 million by the SEC for greenwashing. You and I talked about that, and that's what led to this conversation right here, Jason, because as you know, our conversation was pretty engaging between the two of us, and we got into a lot of stuff that I hadn't thought about. But one of the things you said to me at that time was that you expect to see more of this kind of, I guess, regulatory action against companies in the ESG space, asset managers in the ESG space, because of, I guess, more cracking down by regulators. But my theory is that we're going to maybe see less of it because of some of the things that we already discussed about ESG as a label falling out of favor. And instead of asset managers over the past maybe a couple of years ago trying to be more green than they actually are, they're trying to put all that kind of behind them and maybe be a little more discreet about their ESG. What are your thoughts on that?
So I think that the folks who are out front, right, the big asset management firms, the BlackRocks, the State Streets of the world, are going to revisit their approach in a way that brings it more in line with SEC requirements and rules around reporting. Specifically the names rule 35D1, right? That goes into effect September of 2025. And for those who don't know or haven't followed it, it essentially says that the retail public comes into contact with your name first and foremost, and there should be some consistency with what your name is and what your investment strategy is. And the details of that are 80% of your assets have to be aligned with the marketing descriptors that are in the name of your fund. Mm-hmm. That was not always the case in the ESG space. And that leads me directly to your comment around both Wisdom Tree, which was a $4 million fine, but also Invesco, which was recently also a 17 and a half, I believe, if memory serves, $1 million fine. Mm-hmm. The underlying substance of those two cases were the managers, via their S1s, via their prospectuses, via their registration statements, specifically articulated that they would not be doing something, we will not be buying any company that retails in tobacco or that is involved in weapons manufacturing.
Mm-hmm.
And the reality is that they were hiring third parties. In the case of WisdomTree, it was Sustainalytics and Owl, to provide them an index of companies that conformed to those descriptors that they put in their registration statement. Not only did those research houses not provide good information to them in the form of that index and those constituents, but in turn, WisdomTree had no mechanism internally to have any kind of check on that information. They literally they abandoned Reagan's favorite phrase, trust but verify, right?
Mm-hmm.
They literally just took their word for it. And that's why they got slapped on the wrist by the SEC, because they tried to offload their liability onto the research/index provider and say, we just mirrored the index. Well, how are we supposed to know? And the SEC said that is no longer a defense.
What's the solution for that situation? Because I know you said to me before, the fund management world they're all using the same 3 ESG analytics firms.
Yeah, broadly they are, right? I mean, so if you look at just the market share of a firm like MSCI, you look at the market share of Morningstar Sustainalytics, you look at the market share of Thomson Reuters or Refinitiv, like they're really the big three, right? It's almost like the credit rating agencies. What's interesting though, is we talk about that and make that analog to credit rating agencies. Credit rating agencies agree about 98.5% of the time, right? Looking at the same data, they all independently come to the conclusion, yes, this is investment grade, no, it's not. On the ESG ratings front, you're less than a third agreement. So literally beneath the flip of a coin, these companies looking at the same information, using roughly the same framework, are arriving at the same result. That's a challenge. And then you also have sort of the benefit or the detriment rather of interpretation. So there was a big to-do about it on Bloomberg not that long ago, but when you see a company like Tesla have a lower ESG rating than a company like ExxonMobil, you got to start scratching your head and wonder, well, what is it we're measuring and what is the weighting mechanism and how did all of that work? To answer your question, I think the challenge will be that the rating agencies, the MSCI and Sustainalytics of the world, are going to have to refresh their methodology to become investor-centric to align with the names rule, because that's what the SEC cares about. They're not interested in if you're following your esoteric methodology on whatever it is you've described as materiality and risk. They want to know is, does the retail public look at what you hold and think it matches your name? And the only way to do that is to put the investor first and put the investor lens on. So I'm optimistic and looking forward to that enthusiastically.
What do you see based on all of this, and we'll kind of wrap it up with this question, as kind of the near and longer term future for this category, which I guess we're going to have to stop calling it ESG, but I'm just going to call it this category for this conversation.
You have my permission to use the term values-based. Like, I think that really is what's incorporating it, right? Because it's whether it's faith, sustainability, gender, DE&I, air, water, biodiversity, all of that is values driven. It doesn't have to necessarily be painted with those letters E, S, and G. I just do the simple thought experiment. I think about the students that I teach at the College of Charleston. I think about the children of my friends. I think about everything I read about the next generation. I do not believe that the intentionality of purchase, be that the clothes on their back, where they live, the car they drive, or the stocks they own, is going to change. I believe that we are now committed to understanding the role that corporations play in society, the role that products and services play in our lives. And I think people are going to be interested to know how those things intersect. I don't see that going away. I think, though, if I'm going to break the part of your question into two pieces, I think the research side of it and the data side of it is going to change. And I think that the way that fund companies talk about their products are going to change. Now, in the near term, right? That's my long-term prediction. That's my, way past the next 18 to 36 months. In the near term, I think people who manufacture these kinds of products are going to very quietly look for liability and other challenges that are embedded in the process that they currently have and try to mitigate that. And then I think everyone's going to kind of keep their head down and their voices very hushed while we wait to see what happens in a Trump administration and in a Trump SEC. I will say this, though. I believe that Chairman Gensler will be out on day one, and I believe that Hester Pierce will be his replacement, and that was the appointee to President Trump's appointee onto the SEC. But I'll point to the listeners that, Commissioner Hester Pierce voted for the names rule expansion. It was a 4-1 vote, and she was a Republican vote yes, because I believe there is a commitment to protecting consumers from what they consider to be predatory practices as it relates to this. Now, whether they're singling out ESG unfairly, I don't know, but I do believe that they will be looking at it closely and that enforcement's going to be up because it's on their radar. The same way I'm almost certain that the enforcement action and the regulations around crypto is going to be way down because it's on someone else's radar in a positive way.
Okay. Well, Jason, good stuff. We're going to leave it there for now. I'm going to stay in touch with you on some of these ETFs and other products that you said will be coming forth from your direction. In the meantime, I am Jeff Benjamin, and this is Advisor Insider. Thanks for listening. I want to thank our guest, Jason Britton, founder of Reflection Asset Management. I want to invite you to go to ETF.com and check out the Advisor Center. We've got a lot going on there, and we're always looking for ideas, and we're always looking for sources and stories. You can reach me at, my email is jeff.benjamin@etf.com. Thank you very much, folks.